Hi everyone and welcome to the Panic Drop channel. In this video, I will be discussing the current state of the S&P 500 and Nasdaq charts as well as providing some insightful market data for April. Let's begin with the S&P 500. In March, the index closed 3.5% up, marking the highest candle close since July 2022. Furthermore, the market is up 17.3% from its previous lows, but it needs to increase by 20% to officially end the bear market. Currently, the index is below heavy resistance, and breaking this level would be a strong point for the bulls. Looking at the weekly chart, we can see that the S&P 500 has broken above key moving averages like the 20, 50 and 150 weekly moving average. You can see the pattern of higher highs and higher lows. It would be good to see a new higher high, which means the uptrend continues. The Nasdaq has been performing exceptionally well with a 9.5% increase in March. This marks the highest monthly close since March 2022. The current increase of 26.3% from its lows confirms that the bear market has officially ended and the market is on a confirmed uptrend. The weekly chart further confirms this trend as it closed above all significant moving averages and displays higher highs and higher lows. The daily chart shows an uptrend with the 50 moving average crossing above the 150 moving average and both of which are sloping up. The Nasdaq is also trading above the 200 moving average, which is also showing a positive slope. And these are all signals that the bullish sentiment is returning. As the saying goes, the trend is your friend, indicating that the current bullish price action is likely to continue. However, the short-term fluctuations are unpredictable and the 50 moving average may cross back below the 150 moving average, leading to a new bear market. Now, here is some data on the S&P 500's historical performance in April. This graph illustrates the average percentage change for each month since 1926, providing almost a century's worth of data. As you can see, April here is one of the most bullish months with an average gain of 1.4%. It's also worth noting that investors' current sentiment is quite bearish, and this recent data shows you that over 48% is quite bearish. So they believe the market is going to go down in the next few months. And these are investors waiting with cash on the sideline to deploy. In fact, money market funds have reached a record 5.1 trillion, a staggering amount of cash that has been pulled out of the stock and crypto market. Looking at the 2-week change in money market funds, it has spiked by $238 billion in the last 2 weeks. And this exceeds even the levels seen during the dot-com and financial crisis, but only gets surpassed by the COVID pandemic crisis. So again, this points to a bearish market sentiment with close to 50% of investors expecting the market to continue to decline. However, this also presents a contrarian opportunity since historically when the majority of investors are bearish, the market tends to move in the opposite direction. It suggests that many investors have already sold their assets, resulting in large amounts of cash on the sidelines. And if the sentiment shifts, it's likely that this cash will pour back into the markets, driving the market even higher. Conversely, when the majority of the investors are bullish, everyone has already bought, leaving no one left to buy, and the market tends to roll over and crash. Here is another image showing that investors are mostly in cash and the US equities are in negative. So retail and fund managers are heavily in cash right now. Now, it's important to remember that whether the market is bullish or bearish, it shouldn't affect our investment strategy. Successful investors like Warren Buffett, Peter Lynch, and Charlie Munger base their investment decisions on the fundamentals of a company and its undervaluation rather than external factors like the market predictions or news. I know it can be tempting to sell stocks in anticipation of a market turndown or recession, but trying to time the market can be dangerous. If you sell and the market continues to rise, you miss out on potential gains. Conversely, if you wait for the market to hit rock bottom before buying back in, it may never get low enough for you to feel comfortable investing again. Because studies show that time in the market is more important than timing the market. In fact, investors who try to avoid bad days often miss out on the best days, causing them to underperform the market. So by holding onto the S&P 500, you can expect the average return to be 10% annually. However, the average investor typically only gets 3 to 5% return due to jumping in and out of the market or paying high fees to fund managers. I, for example, only invest in the top 1% companies of the world, and the returns can be even higher with an average return of 20% over the long run. And my strategy is also to simply hold because it's important to remember that missing even a few of the best days in the market can have a significant impact on your returns. For example, missing just 5 of the best days over a 40-year period can cause returns to fall by 38%. Missing the best 10 days can result in a 56% reduction in returns, while missing the last 40 days means missing out 84% of the potential gains. So, in conclusion, it's best to stay invested and avoid the risk of missing out on those crucial days. Now, that's only my strategy. That's it for today. Thanks for watching. I hope you found this content helpful. If you did, please don't forget to like and subscribe to stay tuned for more videos like this. Take care and have a great day. Bye bye.